Okay, fact number 3. She recognizes revenue of $7,400, of which $1,700 is collected in cash, and the balance is due in September. All right. If you notice over there, we've got a revenue account. Let's fill it out for fact number 3. $7,400 goes up. She's a lawyer. She's provided some kind of legal service, and she is due to receive $7,400. However, the client in her office leaves and gives her a check for only $1,700 in terms of a check. Okay? Check is equivalent to cash. We'll learn that later, but you can think about check if you want. If it helps you to think about a big wad of $1,700 in cash, that's fine. Think about direct deposit. It's all immediate payment that goes into her account. Now, we don't balance. Notice that we don't balance. So what we're going to want to do is we're going to want to set up the account that we use when we show that we have a right to receive money in the future. And that's called the account receivable. We looked at that earlier. And it's going to be $5,700, okay? Now, if you've already done this problem, or if you can do math quickly in your head, you might know where I got the $5,700 from. But in case not, we need our accounting equation to balance. We earn $7,400 in revenue, and the two basically think about forms of payment. One form of payment she received was cash here. The other form of payment is the account receivable. It's basically a promise to receive. Okay, the client's going to pay her. Now, what I did, and what you can do, is $7,400 minus $1,700 gets us to this $5,700. And ultimately, what we want the accounting equation to balance, right? We want cash plus the account receivable to equal the revenue, and it does. Okay? Fact number 4, she purchased additional equipment for $2,000, paying $300 in cash and balance on account. So she goes back to the paper supply company, which also happens to sell maybe high-end printers. And again, if you've seen that show, you know that the plot line actually does evolve from paper into printers. Again, if you haven't seen the show, I recommend it. So she purchases $2,000 of equipment. Now, here's where we need to start to think about tangible goods, tangible assets having value, okay? And the way we reflect those assets as part of our business is in this accounting context, okay? So we want to show the $2,000 of value in the equipment account. We also want to show that we paid $300 of cash, because we did, right? Cash went out. We used one asset to obtain another asset, but she didn't want to use all of her cash. She wanted to shell out $2,000 all at once. Instead, she says to the paper and printer supply company, bill me and I'll pay the remainder on account. So there's a promise to pay that's been set up, and that amount, of course, is the $2,000 minus the $300, which would be $1,700. And that's the account payable going up. She has a new promise to pay, so it goes up, okay? All right, fact number 5. Got time in this video to do one more fact. Fact number 5, she paid salaries of $2,600, rent for August of $1,000, and advertising expenses for $350. Okay, again, a little bit of interpretation is needed here, and it might not be immediately obvious on first reading it. These are expenses. She's got employees in her company. She has storefront. She has an office where people can come and meet her and consult with her in private. And she has advertising, maybe on Facebook or social media, maybe a banner out on a park bench or something. It all is expense. It's the money that she has to spend in order to make money. You ever heard the expression, you don't make money unless you spend money? Well, the expenses are what you're spending in order to make the money, okay? Now, I'm going to, on the screen here, show the 3 expenses in detail, but I'm going to show on the whiteboard just the one aggregate sum total, and that's really just for presentational and ease of kind of like getting through this exercise. But I do want to make one point. We would have separate accounts for advertising expense, salaries expense, and rent expense. Each expense has its own account. And we went over that in the previous video. So the total here is $3,950. She has $3,950 of expense. And I'm going to show this with a negative, and I'm going to explain why. It's a negative because her owner's equity is being reduced because she's paying the expense, okay? The idea here too, we're told that she paid for this, and we don't see anything about on account here. So the idea here, we can infer she paid cash. So her cash is going to go down by $3,950. Okay? I'm going to cover the next few final facts in the next video.